Hello there, you are watching Sky News Today. Now, any moment now, we are expecting to hear whether or not the Bank of England has halted its rise of interest rate rises following that surprise fall in inflation yesterday. The decision is expected at midday, and of course, if it does choose to increase rates again, then many people could be in for bills going up. Let's bring in our business presenter, Ian King, for more on this. So, Ian, the rate decision is about to drop any moment now.
I can tell you, Kamali, in the last few moments, the Bank of England monetary policy has decided to pause on its run of interest rate rises. Bank rate held at 5.25%. This is the first time in 15 meetings of the Monetary Policy Committee that it has not raised interest rates. Obviously, it began raising interest rates in December 2021 when they stood at just 0.1%, 1/10 of 1%. Obviously, there have been 14 consecutive interest rate rises since then, but the Bank of England has decided to keep interest rates on hold today. I will try and dig up the comments from the Monetary Policy Committee. Obviously, there's been, here we go, I can tell you what they've said now, Kamali. The Bank of England's Monetary Policy Committee, it's a very, very tight vote, actually. They voted by a majority of 5-4 to maintain bank rate at 5.25%. 4 members of the Monetary Policy Committee voted to raise bank rate by 0.25% to 5.5%. I will try and find out who voted, the breakdown of the votes here. Obviously, that has been based on what has been going on. We got that surprise drop in inflation yesterday. The August inflation number came in at 6.8%, 6.8 to 6.7%. That's very unexpected. But I'm looking also at what the bank has said here. It seems to be that big drop in headline inflation that has made it easier. The bank, obviously, though, remains very, very concerned about wages inflation and services inflation as well. The minutes conclude that the MPC will continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and services price inflation. Monetary policy will need to be sufficiently restrictive for sufficiently long to return inflation to the 2% target sustainably in line with the committee's remit. So I think basically what the Bank of England is saying there is that interest rates, whilst they've decided not to raise them this month, they're going to be keeping them relatively high for the time being, which is in line with what we heard last night from the US Federal Reserve. Obviously, the Fed last night kept interest rates on hold, but the commentary was quite hawkish, and it suggested that rates will remain higher for longer. Now, I can give you the breakdown of the vote here now by the Monetary Policy Committee. Those voting in favour of keeping rates on hold, crucially, they include the Governor, Andrew Bailey, and his Deputy, Ben Broadbent, also voting to keep rates on hold. Dave Ramsden and Hugh Pill, the Chief Economist at the Bank of England. No real surprise there. Hugh Pill had indicated in some of his recent statements that he favoured a modest pause. The other member of the MPC who voted to keep rates on hold is Swati Dhingra. Again, no surprise there. She's been the most dovish member of the Monetary Policy Committee. However, voting in favour of another interest rate rise were John Cunliffe. He, of course, is another of Andrew Bailey's deputies. Megan Green, she's the newest member of the Monetary Policy Committee. And then Jonathan Haskell and Catherine Mann. Both of them are the best-known hawks on the Monetary Policy Committee. Not a surprise to see them voting for another rise in interest rates to 5.5%. Well, we haven't got that this month. It is a massive day, I should say, for interest rate decisions right around continental Europe. Earlier this morning, the Swiss National Bank voted to keep interest rates on hold. That was a bit of a surprise. We also got interest rate rises in both Sweden and Norway, which does rather suggest to you the fact that there are still interest rate rises coming through around the world. We're getting the Bank of Japan tomorrow, and they're expected potentially to tighten monetary policy or indicate that they will tighten monetary policy right now. Very, very interesting line. I'm just looking at the minutes of the MPC here. They're saying, given the significant increase in bank rates since the start of the tightening cycle, the current monetary policy stance is restrictive. The bank obviously very, very still concerned about wages, inflation. Looking at some of the other comments they're making, they are noting the fact that market pricing, the market had been expecting, until those inflation numbers dropped yesterday, a rise in interest rates today. The bank says also in the minutes of the Monetary Policy Committee, there continues to be evidence that interest rates in financial markets have continued to be more sensitive to economic data outturns, particularly in the United Kingdom, than had been usual over the last decade. These data outturns could be volatile month to month. That almost sounds like a sort of cry for help from the Bank of England, really. They're sort of pointing out there that it is much, much harder to assess what market expectations are for further interest rate rises. And that, of course, feeds into their ultimate decisions because the markets are moving around in a much more volatile manner. Now, crucially here, it shows again that the bank is still... I'm looking at some of the comments they're now making on the bank's agents. Now, these are the network of regional agents that the Bank of England has around the country, which talk to local businesses, find out what's their minds. And it's very interesting to note here, the agents have noted a further sign of loosening in the labour market. Now, that really chimes with some of the figures that we've heard lately. We've had this very, very modest uptick in unemployment. But the MPC minutes go on to point out here, the labour market does remain quite tight by historical standards. The agents report an easing in recruitment difficulties, but also persistent skills shortages in some sectors. So that's the big headline this hour, Kamali, a big, big moment. The Bank of England, for the first time in 15 meetings of the Monetary Policy Committee, has not raised interest rates, but there are plenty of hints here that interest rates are going to remain at these sort of levels for quite some time to come.
OK, Ian, do appreciate that analysis, that news again. The Bank of England has decided to hold interest rates at 5.25%, as our business presenter Ian King was explaining there. Let's bring in our economics and data editor, Ed Conway, who is outside the Bank of England for us now. So, Ed, look, they've held rates. Does that tell us that the Bank of England thinks that those increases have done their job? And do you think it means going forward?
Well, it is undoubtedly a big moment. If you think about it, we have just been through the longest period in modern economic history of the Bank of England, raising rates one meeting after another for 14 meetings. We have been coming here to try and find out what they've been doing. They've been facing this cost of living crisis, seeing inflation going very high indeed, up to double digits levels. They've raised interest rates from 0.1%, so the lowest they've been in history, all the way up to where they are now, 5.25%. And for the first time since late 2021, they've paused. So they have paused and they have left interest rates unchanged. It is still about as fine a margin as you could have hoped for in this meeting. It is 5-4. So the Monetary Policy Committee, the people who decide on this, there's 9 members on that committee. It was a 5-4 decision. 5 people voting in favour of keeping rates unchanged, 4 people voting to try and raise interest rates. Just to give you a sense of how close it was, and to give you another sense of how close things were, just yesterday, the markets thought there was an 80% chance of increasing interest rates today, that the Bank of England would increase interest rates to 5.5%. Obviously, we then had that inflation data, that fateful inflation data that came in a lot lower than expected yesterday. The bank has looked at that. It's looked at the rest of the data facing the UK economy at the moment, and it said, well, right now we can leave things unchanged. Does this pretend that interest rates are now at their peak? We don't really know, but you'd have to guess there's a good chance of that. Does it mean that interest rates now, having reached that peak, are going to start coming down? Well, the bank is indicating they may well be there for quite some time to come. But nonetheless, it is certainly one of those moments. We've been stood outside here so many times over the course of the last couple of years and had the same story to tell. The bank is worried about inflation. It has raised interest rates in order to try to bear down on our spending in the economy. And that, of course, has had an impact on so many people, millions of people around the country, seeing their mortgage costs going up, businesses seeing their cost of doing business going up as well. As well as that, you have an impact on savings. So savings rates, for the first time in a long time, have also gone up. Well, that process of raising the cost of borrowing across the UK may have come to its peak, and so it's one of those interesting moments. But still, all eyes on this place, because the cost of living crisis, that's not gone away. Inflation's still at 6.7%, way above their target of 2%, and whether they need to do more, whether they need to pause for quite some time, with interest rates still at this really high historical standard when you're looking at recent years, when you're looking at the debt burdens facing people, well, that remains to be seen. But certainly a big moment here at the bank.
Certainly is, Ed. And in the past few minutes, the Chancellor of the Exchequer, Jeremy Hunt, has responded to this. Let me just read out what he had to say and then get your thoughts on his words. He says, "We're starting to see the tide turn against high inflation, but we continue to do what we can to help households struggling with mortgage payments. Now is the time to see the job through. We're on track to halve inflation this year, and sticking to our plan is the only way to bring interest and mortgage rates down." I mean, kind of echoing, Ed, what the Chancellor said yesterday, that the plan is working when we saw that slight drop in the rate of inflation. And also they're hinting, of course, that he's going to continue to try and help people who will have seen their mortgage payments going up as a result of this current level of interest rates.
I think that the thing to remember, and it's slightly borne out by there's a kind of subtext in what the Chancellor is saying, is that, just because interest rates didn't go up again this time around, it doesn't mean that interest rate pain isn't hurting many families, millions of families around the country. Just the nature of the way, if you have a mortgage, you will know the way that we all refix our mortgages these days in mostly 2 and 5 year cycles. I mean, it's a gradual process. For a lot of people, they have yet to see that pain in their pockets. But when that pain actually starts to manifest, it is a very big jump for those households who have mortgages at the moment. And by the same token, the cost of living crisis is still with us. Inflation, the rate at which prices may be going up, that is certainly coming down. However, those prices are still rising. They're just not as accelerating at quite such a rate as they were before. So, one has to be a little bit cautious about kind of saying that we're kind of at the end of the tunnel, but definitely what we've seen in the last couple of days is some light at the end of the tunnel. And now when we're kind of looking towards the next few months and indeed the next few years, it doesn't look quite as much of a grim picture as it did before. And frankly, we've had so much grim economic news recently. The bank has had so many questions about why it's not been able to bring inflation under control. Is it quite under control yet? I don't think they'd be so sure about that. And I was just at a briefing. We're looking through the data, looking through the minutes, and we'll hear from the Bank of England Governor later on this afternoon, as well as the Chancellor you mentioned just a moment ago. So there is still a lot of kind of question marks about what happens next. But as I say, it does feel like one of those moments today.
Certainly does. All right, Ed, for now, thank you. More from you once we've heard from the Governor, Andrew Bailey, and from Jeremy Hunt later. Now, let me just remind you, we've got a special programme coming later on today at 1:30, a Q&A where you can ask our panel of experts about today's bank decision and what it could mean for your finances. Do scan that QR code, that one there, that you see on your screen right now, and submit your questions. As I say, that is coming up at 1:30. All right, send your questions in. Now, here to discuss the decision to hold interest rates is the financial expert and founder of Young Money blog, Iona Bain, and a former member of the bank's Monetary Policy Committee, Martin Mill. Iona, Martin, thank you very much for being with us. Martin, let me start with you as a former MPC member. Your reaction to the fact that they decided to hold rates?
Well, I think in the light of the inflation figures we had yesterday, I would have voted to hold rates this time round. The important thing to remember is that if those figures turn out to be a flash in the pan and they aren't as good in the future, you can always put the rate up again. Deciding not to increase rates today doesn't mean the same thing as saying that interest rates are at the top of the cycle. We hope they are, but they may not be.
Yeah, it gives you the space, I guess, to fluctuate if you need to try and control inflation again.
I think that's right, yes.
And Diana, I mean, Ed made the point there, and I could feel you nodding next to me, that, despite the fact that there has been a hold here, and as Ed said, it's a major moment, and for some there will be some pleasure taken from it, doesn't mean that the pain for people who have mortgages is over.
That's right. This news today will definitely come as a relief to the 500,000 or so people whose fixed rate deals are coming to an end in the last 3 months of this year. And for those people, they can expect to see mortgage lenders cut rates in the weeks and months to come. They have already been doing that. It's been described by some brokers as a rate war, and we can see that trend is going to continue continue now. However, you have to set that against a backdrop of rates tripling compared to where they were 3 years ago. So if you look at the average 2-year fixed rate mortgage at the moment, it is still well over 6%. It's probably not going to reach that grim milestone of 7% that was being predicted by some earlier this year, but still that is nearly triple where it was 3 years ago.
Yeah, Martin, I mean, I put this question to Ed, you know, the fact that they've decided to hold now, and as you said, you would have voted for that course of action as well. Does that tell you that the bank thinks that its actions have started to have some impact in terms of taming inflation?
I think probably yes. And no, they will have been looking at what's been happening in the labour market, where things are still tight, but they aren't as tight as they were. And they'll also be allowing for the fact that there are lags between interest rate changes and their impact on inflation.
Well, this is the point, isn't it? Because, you know, we've seen these rate rises. This would have been, if they had done, the 15th rise. It is that lag, isn't it, that people, I guess, consumers need to be aware of, that when you make these decisions, it does take a while for it to feed through into the markets.
Well, indeed, and of course the lag isn't completely predictable. The bank isn't sure how long that impact is going to be. It has estimates, but they are no more than estimates. And
just while I've got you as an economist, I've seen that sterling is at its lowest rates today as a result of what's happened. Just explain to us why that would be.
Well, markets are obviously inferring that interest rates won't go up as much as had been thought possible. If interest rates are lower, then people find sterling less attractive relative to foreign currencies, so sterling falls.
And government borrowing came in lower than predicted as well, I think, today as well.
Yes, that was also good news. Of course, government borrowing with high interest rates is a toxic combination.
Absolutely. And the flip side of this, Iona, that always sticks with me is the fact, you know, this hurts people with mortgages. Mm-hmm. But I guess when rates are high, savers would be liking to see that feeding through. And it never quite feeds through. We may well end up in a position where people with savings never actually feel the sort of the benefit of those rates being at that level.
You make an excellent point there, because these rate rises have certainly not been passed on to savers right across the board. We've seen challenger banks and online banks launching very attractive competitive savings rates. At the moment, you can definitely find an easy access account paying above 5%, fixed rate accounts paying above 6%. But if you are a customer with one of the big high street banks, you will be struggling to earn over 1% at the moment. And actually, the Financial Conduct Authority, the regulator, has been saying to high street banks in recent weeks, you have to justify your low savings rates, otherwise we're going to take what it calls robust action, which could include fines. So maybe that will lead to better savings rates. Let's wait and see.
Just consider what the Chancellor had to say as well. We are going to hear from him later, but he did, in his reaction to this, say that they will continue to do everything they can to help households struggling with mortgage payments. Has there been enough help, do you think, from government to help those who are struggling? Because you say some of them seen their payments go up quite substantially.
To be fair, we've seen repossessions not tick up massively, and also, whilst arrears have gone up by 28% this year, I think the mortgage charter that was put in place this year has definitely helped borrowers. So with the mortgage charter, lenders are committed to giving help to mortgage borrowers if they are struggling with their repayments, and that could include extending their mortgage term or switching to interest-only payments. But it is worth stressing, if you are in a position where you're thinking about taking that help, it is temporary, and then after it ends, actually, for instance, if you take the interest-only mortgage option, your repayments will actually be higher over the long term. So there are lots of trade-offs for consumers to think about, even if they do accept that help.
That's why the language is interesting. We'll continue to do what we can to help. I mean, it's not sort of encouraging. There was a time when we were seeing these rates keep ticking up, that it was, you know, we're going to really step in to try and help as many people as possible. I think now there's a tempering of language there, isn't there?
Yes, and I think that the message is still, as a consumer, if you are struggling with your mortgage repayments, then look at where you can make cutbacks elsewhere before you go to your mortgage lender.
Martin, let me get a sense from you as a former MPC member, as the sort of the decision-making that will be going on the committee, and also from Andrew Bailey. You know, he's been politicised recently about his decision-making and whether or not he should have cut rates sooner. I mean, you can give me your opinion on that. Now that he's made this decision, which Ed has said is quite momentous. You know, it shows that he's trying to do something here. Do you think that some of that pressure, that political pressure, will ease off? We're going to hear what he has to say later on this afternoon.
Well, I think what I'd say is that the decision isn't Andrew Bailey's decision. The decision is the decision of the committee. The members of the committee are individually accountable to Parliament. They aren't collectively They aren't collectively responsible. So to see Andrew as the decider, I think is incorrect. There were some occasions when a previous governor, Mervyn King, found himself in a minority on the committee. That wasn't the case this time, but it's important not to see the decision as that of the governor. And, of course, when you have a committee, the committee can be split. It has been split. Some people say, why can't the committee agree? To me, it seems that the committee is working when you have a range of views, and at a turning point, it's quite likely that you will have a range of views.
Yeah, Iona?
Well, what's been really fascinating is just how much mortgage lenders have been watching Andrew Bailey's comments.
Everything he says.
Absolutely. They've been hanging on his every word. And we saw just when he was implying recently that we might be coming to the end of these rate rises, that's when they started cutting rates. Although I should probably add a note of caution here, they've not been spectacular rate cuts. Even though some brokers have talked about a rate war, I saw one broker talk about it as more of a pillow fight. The actual rate cut has been, as much as 0.5 percentage points. So it isn't spectacular, but actually that will translate into a lot of money over the lifetime of your mortgage.
It definitely will. Martin, look, on this idea of sort of signalling and hanging on every word that Andrew Bailey says, is that a new thing? Was that always the way that, we passing every single utterance from the Governor of the Bank of England? Was that a new thing that's come in recent times?
No, I don't think it is. I think people have always looked to the Governor for signals, and the point I was making was that it's not his decision. He may influence the way that other members of the committee vote, but as I said, there can be occasions when actually he's in the minority.
And last final thought from you as well, Martin, 5-4 decision. It shows just sort of how divided or the difference of opinion that was on the committee.
Yes, indeed, and you'd expect that different people would come to different conclusions from the same data.
OK, Martin, Iona, thank you very much for that. I really appreciate it. Learned a lot. Thank you very much.